Hi everyone, it's Conrad Bobilek here, CEO of Investors Prime Real Estate and author of Australian Property Finance Made Simple. And I've made a really cool video for you guys today about negative gearing, because I keep hearing about negative gearing in the media all the time, mainly because there's a massive, critical point now in Melbourne and Sydney where people are completely priced out of the inner ring suburbs. And there's a critical shortage of prime stock, both in Melbourne and Sydney. And obviously, people with no property or the Labor government is always attacking investors because we're apparently responsible for creating this shortage, and we're apparently responsible for locking the young generation out of the housing market. And the thing that comes to be every few years is this discussion about negative gearing. And the theory is, which is created by academics with no property, is if we roll back negative gearing, then miraculously all the investors will let go of all their properties and the whole market will be replenished. Younger people can get into the market. We can all hold hands and sail off into the sunset, living happily ever after in houses in the major capital cities. And of course, it's all baloney. So what I wanted to do is create a video explaining negative gearing, exactly what it is, and why it has virtually no relevance when it comes to property investing. And this is a very much a misunderstood area of property investing. And normally to me, negative gearing is kind of a nonsense topic. It's really just tax minimization and maximizing deductions, which is really not the reason you invest in property in the first place. You only invest in property to make money. It's okay to pay tax. Guys, you gotta understand, the only people that talk about not paying tax are people with no money. I know a lot of rich people that have no problems paying tax. They pay millions of dollars per year in tax, and guess what? They keep millions of dollars as well for themselves. The only people who talk about paying tax and not paying tax are people that make $500 a week. So what I wanted to do is just cover this topic once and for all, because quite frankly, I'm actually sick of hearing about negative gearing. I've been hearing about it for the last 15 years, and I have very little interest in negative gearing. Having said that, I want to do an exact, very specific example of negative gearing, and I'm going to show you two examples. One is an apartment and a townhouse, and how negative gearing actually works. Now, before obviously we get started, company disclaimer, this is all educational. And number two, personal disclaimer, all I'm going to show you is a bunch of things that work for me. I'm not here to make you a property millionaire or to give you any advice or tell you that by following anything that I'm talking about at all, you're going to become wealthy. Just like joining a gym, there's no guarantee you're going to get fit and look like Arnold Schwarzenegger just because you put a gym membership. Would you agree? You actually have to go to gym and do the hard work and do the hard lifting. Same with property investing. So what is negative gearing? In a very simplistic way, okay, I'm talking about a super simplistic way, this is what negative gearing is. This is Bob. He pays $20,000 per annum in interest on investment property. Okay, let's forget about expenses and everything else. But when he only earns $10,000 per year on renting the property out. So he's paying interest of $20,000, his rent's only $10,000. If Bob's income is $85,000 per year, he can subtract the $10,000 loss, the difference between the two, against his income from his job. That's all negative gearing is. Negative gearing has two words, negative and gearing. Negative means that there is a gap, a negative gap, between the rental that you're getting from a property and the amount of interest, so the interest that you're actually paying on the property and the rental that you're getting from the property, and the rental's not covering the interest. That's the first part of the equation. Gearing simply means that you've borrowed money to hold the property, okay? Now, the easiest way to turn a negatively geared property into cash flow positive is just pay a 30% deposit. Then it all instantly becomes cash flow positive. The most important thing to understand about negative gearing, it's not an investment strategy. It's a tax outcome, okay? Let me say that again. Negative gearing is not an investment strategy. It's a tax outcome. It's the relationship between the interest that you're paying on the property and the rental. It has nothing to do with the underlying asset and its ability to perform. So in Melbourne, there's 390 suburbs, probably about 45 worth investing in. You get the same negative gearing deduction on virtually all the properties in Melbourne, based on price point, obviously, and when they were built. That has nothing to do with any kind of influence or determination or whether the property that you're buying will actually appreciate in value. Okay, so that's a very important distinction. Now, is negative gearing good or bad? Well, obviously, It's good if you're losing money and you have the ability to claim expenses against your income, but really it's irrelevant. It's really irrelevant. You cannot become wealthy by saving money on taxes or not paying your taxes. It's kind of like, it's got nothing to do with what we're here to do. We're here to build wealth and build large property portfolios. So who gives a rat's ass about negative gearing? I mean, yes, you want to maximize all your tax deductions like any business owner out there. If you've got a lemonade stand, you have income and expenses, and the expenses should be offset against your income, right? It's a basis of capitalism, right? But really, negative gearing to me, it's just irrelevant, you know? And you notice the only people talk about negative gearing is people with no property, academics or accountants. If you look at the Australian population, these are figures a little bit old, but they haven't really changed much, you know, and this is the amount of property investors that are out there. You've got to understand that 72.8% of all investors in Australia only have one property. So they have a house most of the time and have an investment property, okay? 6 or more investors, so people with 6 or more, properties, you're looking at 0.9%. So these are investors with 6 or more properties. But look at the figures, right? People with one property, and this is the amount of actual houses, 1.2 million homes owned by Australians, families and Australians with just one house and one investment property, okay? If you look at the amount of investors that are out there, 6 or more, 15,000 homes that are held by the investors that have 6 or more properties. So the most important thing about negative gearing is this. If you don't get negative gearing, if you don't have the ability to offset your losses against your income, you could draw the same income out of your equity from your house. So the theory is that if you roll back negative gearing, then people would sell properties. And I can tell you now, nothing could be further from the truth. Because if you're missing out on $10,000 or $15,000 in tax deductions per year that you're able to claim, you know, and get a tax credit, then you can draw equity out of your home. Like, I would never sell my properties if negative gearing was rolled back. So the reality is this argument about negative gearing, you know, pricing young teenagers out of the property market, it's all crap. It's just tax deductions. You know, it's got nothing to do with it. These people here that have one property, which is 72.8% of all investors in Australia, if their negative gearing deductions stopped, which I'll explain what they are exactly in detail in a second, on the apartment and townhouse, all they will do is get the equity out of the home and use the equity to pay for the shortfall. They still wouldn't sell their property. Why would you sell an asset with 600,000 that's making you 60 grand a year, okay, minimum, and in some best areas in Melbourne, we've had 18% growth last year, just to save 5 or 10 grand? It doesn't make sense. And see, this is the problem with the Labor Party, or what I call the Socialist Party, who are always saying, oh, it's the greedy investors that are, you know, destroying the market. The reality is Melbourne's expensive, Sydney's expensive because it's the most livable city in the world. It has to be expensive. You know, there's no point whinging about it. They could have just deal with it. It's like saying, oh, I really want the Mercedes S600, but it's $500,000. Can't it be cheaper? No, it freaking can't be cheaper, okay? Life sucks, wear a helmet. And their 600 costs $500,000. If you want one, get to work, make the money and freaking buy one and stop whinging. And that's what I want to tell these people about, oh, everyone's priced out of the market because investors are pricing people out of the market. It's just baloney. Most property investors, however, have a practice of buy, hold and pray investment strategy, which is why most people fail. I can guarantee you most of these people that bought one property have no property strategy or plan. And most of them have bought a property within 3 to 5 kilometers of where they live, just so they can keep an eye on the property in case it runs off, you know, one day. One day you're driving on the road, oh shit, the house is gone. Where is it? You know. And by the way, I have no stats to back that up. It's just an opinion based on 20 years of investing. If you look at the amount of negative gearing deductions that were, or individuals that took advantage of negative gearing last year, and if you look at the tax bracket, people that were less than $20,000 a year, there was 200,000 people who took advantage of negative gearing last year who were less than $20,000. That's the earning per year. 20,000 to 37,000, 179,195. 37,000 to $80,000 per year, there was nearly 500,000 Australians in that tax bracket who took advantage of negative gearing. And you have to be an idiot not to take advantage of it, because what it is claiming your tax deductions. Why wouldn't you claim your tax deductions? If you just get an average accountant out there who's half a brain, he can do the tax deductions for you. It's almost like if you're investing in property, there has to be something wrong with you not to claim your tax deductions. Would you agree? If you're an investor, you have the ability to claim deductions. Now, the argument is always it's the rich that are taking advantage of negative gearing. Billions of dollars every year going to the rich. Well, no, they're not. Because if you look at the income, 80 to 180,000 per year, there's only 313,000, and over 180,000, which is really, today it's not that much money, 69,000 Australians. 500,000 Australians that are taking advantage of negative gearing are between 37,000 to 80,000 a year. They're mums and dads working out there who just want to better themselves. They've held their house for a little bit of time and then they've bought their first investment property. So this theory about it's the rich that are actually doing it, it's not true. If you read the stats, and this is all government data, you can see majority of people that take advantage of negative gearing, which is just claiming losses against their income, just the average mum and dad out there. That's the reality. Now, let me show you a real property example to show you how negative gearing actually works in detail. What are all the expenses that you can claim? And I'm going to use an apartment as an example to start off with, and I'm going to use a townhouse to show you, to illustrate the point. At the end of the day, as I said before, I couldn't care less about negative gearing. You know, I keep hearing about it, and the thing that I'm going to keep repeating is, notice the only people who talk about negative gearing are people with no property. Investors don't talk about negative gearing. You know, it's a given that if you're investing, deriving an income from any asset class, you have the right, in the westernized world, to claim losses or deductions or expenses associated with generating that income, right? It's just like accounting 101. This is a property that one of my clients has purchased in Martin Street, St Kilda, actually not far from where we are right now shooting this video. And this was an off-the-plan purchase, and this is a really cool area. If you know Melbourne, this is just near Balaclava. You can walk down to all the shops, restaurants, some of the best places in Melbourne, walk back to your apartment. The advantage of this property was also, it was called the park, because you had this unique, cool park that was accessible by the tenants by swipe card only. So if you couldn't just walk in off the street. And this is the cool thing about these apartments is that, you know, if you're living in an apartment, what you're really sacrificing is the backyard. In here, we had this communal backyard where you can just chill out, you know, read a book or even have a picnic, and it's all covered by the Owners Corporation, which is really cool. Now, St Kilda obviously has a huge amount of parks just by itself, but this is an extra bonus for those tenants. And just a standard 2-bedroom apartment, you know, nothing phenomenally special about it, just an average 2-bedder. I would say the minimum requirements for a 2-bedder. You can see there, it's a 2-bedroom, 2-bathroom, 76 square meters internal with a study nook, a proper separate bathroom for the guests, and obviously a proper ensuite for the main master bedroom. The external area was 10 square meters, so you've got a small balcony, another balcony of one of the bedrooms. So altogether 86 square meters. Now, you obviously, when you're buying something, this is $700,000, you want to make sure that it's worth $700,000. In this instance, we actually had valuations up front on this property for our clients, which is $700,000 from Chartered Kramer. There's the valuation and there's the purchase price. Now, in terms of the rental, the weekly rent, St Kilda's renting for around 4.25%. You know, and it fluctuates between 3.75% up to 4.5%, depending on the rental cycle. Now, by the way, the rental cycle is always between 3 to 5 years behind the growth cycle. So the higher the growth, the lower the rental, because what happens with capital growth, it kind of jumps up, and then the rental market takes 2 or 3 years to catch up to where the property is actually worth, because usually leases are locked in for 12 months at a time. That's why we've always got this lagging effect. In this instance, $700,000, you know, you're getting a good rental of 4.25%. Then you got your Owners Corporation as well, which is $1,980.35. Now, by the way, with apartments, you have to have Owners Corporation. It does cover your building insurance and insures the common areas, and there's a sinking fund as well. So don't be afraid of paying Owners Corporation. I used to be very anti Owners Corporation, you know, when I started investing, and I used to seek out properties with no Owners Corporation. Well, you've got to pay building insurance anyway. It's about $1,100 for an average property anyway, so you can't get away without paying insurance. Majority of Owners Corporation fees are actually taken up in insurance for the building and maintaining the common grounds. You know, if you ever want to see really tight looking apartments in Elwood or St Kilda, I can show you a bunch of them, and the commonality is they don't have any owners corporation. So the common area is just neglected completely. Then you've got to pay council rates. And on this example, it's $1,745.58 per year. And then you get to claim your deductions on the building. So the actual building depreciates 2.5% over 40 years, and you've got your deductions on the fixtures and fittings. Now I always use diminishing value because I want to have all my taxes up front while the rental is catching up to the growth of the property. But it's something that you've got to really discuss with your accountant. It's very subjective. Stamp duty. And this is the cool thing as well, because this was purchased off the plan, the client only paid $7,091 in stamp duty. If it was a completed apartment in Victoria, he would have paid another $29,979 on top of the $7,091. So these particular clients saved themselves just under $30,000 in stamp duty. Now that's going to change in Victoria as of 1st of July 2017. For investors buying off the plan properties, there's not going to be any more stamp duty concessions. Really, who cares? It won't affect me buying properties. It's another theoretical thing that's going to fire back at the government and make properties more expensive. See, the thing the government can't change is they cannot change the supply part of the equation. That's the thing that I understand. I've got a really beautiful house that I live in with a swimming pool, double story on a 3rd-acre block in the eastern suburbs, close to the city on the 1,300 square metre block. I don't care about negative gearing. I don't care about stamp duty. I don't care about taxes. I don't care about water rates, council rates. There is nothing that the government can do that's going to get me to sell my 1,300 square metre block. And that's it. It's as simple as that. And I'm going to renovate, and I'm never going to get out of that property, okay? And that's what's happening in Melbourne and Sydney. In fact, people are holding on to properties in the best suburbs in Melbourne for up to 15 and 17 years, where 20 years ago it was 7.2 years, and in the 90s, in 2000 it became 11 years. Now it's 15 to 18. And why not? We've got the right to hold on to our properties. That's why we buy them in the first place. So here's the example with this particular scenario. We've got a 2-bedroom, 2-bathroom plus car park and storage apartment, 76 square meters, good size, not phenomenal, decent size, 10 square meter balcony, so 86 square meters in total. $700,000 off the plan, stamp duty $7,091, weekly rental 4.25%, which is $570 a week, which is pretty standard for St Kilda, and you've got your depreciation. Now we can do a basic negative gearing equation to work out what the losses are. I'm going to throw in my clients in here, and I'm not going to use the real names for privacy reasons, but let's call them Bill and Mary Smith. Bill's on 85, Mary's on 50. They've got a good credit file, house with equity, and they're borrowing 100% of the $700,000 plus associated expenses. They're actually doing a 95% loan plus LMI capitalized, but they actually took out 7% equity from their home. Okay, so when you're doing cash flow analysis, just do it at 100%. Even if you've got equity in the home, or even if you've got a cash deposit, it's the opportunity cost of using that money. So just allocate a 4% interest rate to that money. So in terms of the purchase cost, so you've got a $700,000 property, purchase cost $8,291, which is your legals, cost of setting up a trust, conveyancing, everything. Current income for Bill, 85 grand. So he's paying $21,097 in tax. The weekly rent on that property is $29,334. Now what happens to the weekly rental, it just gets added to your normal income. Okay, the ATO doesn't differentiate between your rent income and your job income. It's all just income. It just gets grouped together as one income, and then you get one marginal tax formula, put onto that income. There's no difference between rental income or job income. So new income goes up from 85 grand to $114,344. Deductions are $61,584. All the deductions, which is, I'm about to explain that, so it's interest, all the holding expenses associated with the property. So the new taxable income drops down to $52,762. New tax is $9,542 instead of $21,097. So this is what negative gearing is. Bill's new taxable income actually drops on paper from $85,000 to $52,746. New tax payable, $9,542. So he's saving $11,555 in tax credits because he's making a loss on the property, which is $216.85 a week. Deductions are interest on the property, $32,219. Depreciation on the building itself, which is 2.5% over 40 years, $12,475. Depreciation on fixtures and fittings, $7,691. And other expenses for the year, $9,195. Insurance, land tax, I mean everything, right down to green bins and landlord's insurance. So total deduction, $61,580. The weekly costs are finance, $619.59. Rates and maintenance with the property. This is the average broken down over weekly costs, $166.82. So the total is $786.41. And this is the magic of property. Your expenses are $786.41 minus the rental, minus tax, bill or you out of pocket 44 cents per week, which is really cool. It's less than $1. That's how much you can, so if you can buy a property in Melbourne with negative gearing, it costs you less than $1. So, but here's the reason you invest in property in the first place. It's not because of these tax deductions, okay? The reason is because of the equity. So in year 3, based on 8% growth, which is conservative for St Kilda, Bill's gonna have 165 grand in equity, you know, and then he'll buy another property over here. In year 5, the property will have 312,000 equity, less where he drew out before. You've got another deposit for a property. You know, negative gearing is basically these amounts here before the property becomes cash flow positive, net, after all expenses. And these are your tax credits. This is how much Bill's getting from the ATO, and this is his net effect. So it's cash flow positive from day one. Now, the argument for negative gearing is, if we roll back negative gearing, then investors won't buy these properties, therefore there's less demand on property, and therefore there'll be a massive surplus of properties released on the market. Everyone can go in, hold hands, one off into the sunset. And it's absolute bullshit, because the reality is Bill doesn't need these tax credits to buy this property. Bill has equity in his house. It's very easy for Bill to take $11,485 in the first year equity out of his house to pay for the shortfall. And then next year, $10,000. So if you add these up together, okay, 11, 10, so it's, let's say 20, 30, let's say it's 45 grand, okay? Would you invest 45,000 over 7 years equity out of your house to make $483,000 return? 45 grand, 483,000. Would you do it as an investor if you had the equity and the income? Of course you would. So he gives a rat's ass about negative gearing. It's got nothing to do with it, you know? It's just one of these things that people bring up every 5 years, thinking that's the evil that's responsible for all these properties going up. Properties are going up in Melbourne because people want to live here. It's the most livable city in the world, and we are landlocked virtually in every direction, and we have a very fragmented market. We have suburbs here that are premium suburbs, and we have suburbs here that are not premium suburbs. And people always want to live in the best suburbs, located close to the city, close to water, where the best schools are, where the best lifestyle areas are. And for that, because it's the most livable city in the world 6 years in a row, guess what? You've got to pay a lot of money to live there. That's the reality, you know? So the argument is that if we get rid of the ability for investors to claim tax deductions, and suddenly they wouldn't buy that, that would mean that investors would have to say, if I have to spend 45 grand to make 483,000, I think I'll give that a miss. Ask yourself, do you think there's going to be a point where investors will get to that point where they'll say 45 grand over 7 years or $500,000 in profit? Tough decision. Let me sleep on it. Maybe I'll buy some Telstra shares. You know, come on. It's just baloney. And then the reality is after 10 years, this is the first year, your tenant and your taxman is paying the whole bill. Really, with negative gearing, you're out of the equation completely after 10 years. You're not contributing anything to the property. But even with negative gearing rolled back, it doesn't really make a difference at all in the grand scheme of things. Okay, so here's a second example, which is a townhouse, just to give you a comparison difference between townhouses and apartments. Obviously, as a preference, townhouses are virtually always superior compared to apartments because they've got a land component, and there's scarcity around townhouses as well, because you can only build less of them in the suburb, mainly because the footprint that they have is larger than an apartment. In this example, we're looking at Aspendale, which is unit 4 of 100 Station Street in Aspendale. This unit's sold, and this is a really cool 3-bedroom townhouse. Downstairs on the ground floor, double lock-up garage, open plan living with a toilet for the guests, little courtyard at the back. Upstairs, you have 3 bedrooms with the master bedroom being oversized with walk-through robes and an ensuite. 183 square meters, which includes the garage. So really good, decent size, only one of 4 on the block. Aspendale is a great area in Melbourne. It's definitely up and coming. It's an area for investors to look out for in the next 5 years. Now, once again, and I'm going to run through this fairly quickly because it's very similar to the previous example. We're really just talking about negative gearing, versus cash flow positive properties. So in this example, you've got an independent valuation, okay, from Giles Valuation Services, $740,000. Rent's about $600 a week. You've got Owners Corporation, about $1,100. There's virtually no Owners Corp in this because apart from building insurance, there's just a laneway that you've got to insure and that's it. There's virtually no common land apart from the driveway on the side of the property. Council rate's about $1,100 per year. Then we've got depreciation from BMT, $13,301 for the first 12 months. And that's broken down between Division 43, which is your building depreciation, 2.5% over 40 years, and your fixtures and fittings. Once again, stamp duty was payable in off the plan purchase, so it's only $10,430 compared to $28,140 saving. So if this investor were to buy the property as an established townhouse, he'll be paying $39,000 in stamp duty. Now in Melbourne, and this is going to cease to exist as of 1st of July 2017, if you're buying an off the plan purchase, you only pay stamp duty on the land component, not the build. Okay, so in this example, the land component was $296,000, so the stamp duty was only applicable on the land component, which is pretty cool. Now, let's do the numbers. So we've got a 3-bedroom, 2.5 bathroom, 2-car garage and storage townhouse, 183 square meters, very good size for a townhouse for the Bayside. $725,000 off the plan with a 740 valuation. So valuation came in slightly above contract, which is cool. Stamp duty, $10,430. Weekly rental, $600 a week, which is about 4.17%. And then you got your depreciation on the building and the fixtures and fittings, $13,301, diminishing value. Once again, Bill and Mary Smith, Bill's on 85, Mary's on 50, clean credit file, and we're doing the same calculations as we did before, allowing for 100% borrowing costs, including closing costs of the transaction. So we have the purchase of the townhouse, $725, purchase cost $12,430, stamp duty, legals. You've got current income of Bill, $85,000 a year. The tax that he's paying is $21,097. The rent is $600 a week. So you can see once again, the rental just simply gets added to Bill's income from $85,000 plus the $30,576 to $115,576. But before he pays tax, he gets to claim tax deductions, which is $64,218, which is incredible. That's for the first 12 months. So the new taxable income drops down to $51,358 on paper. New tax that Bill is paying is $9,036 compared to the old $21,097. So all taxable income $85,000, new taxable income $21,097, which is a tax saving of $12,061 per year or $231.94 per week. And your deductions are your interest repayments on the loan, which are $38,024, the deductions on the build, deductions on the fixtures and fittings, then you got your expenses with the property, loan costs, etc., $64,218. These are actual figures from the accountant, by the way, on this transaction. Weekly costs of finance and rates and maintenance. And once again, in this example, the expenses for holding the property, all inclusive, are $884.19, minus the rent, minus the tax, Bill's out of pocket $52.25 per week to hold this property, which is pretty cool. Now, once again, negative gearing is really not that important because in year 3, this is how much you're spending per year if you had no tax deductions, and these are your tax credits. And this is the shortfall. In this example, you are paying money to hold onto the property, and in this example, it's $3,342 in the first 12 months, then $1,392 in the second year, and just goes on and on. Who cares about the holding costs? That's the thing. Look at the equity position. In year 3, you've got 171 grand. You know, in year 5, you've got 326,000. In year 10, you can make 837,000 equity at 8% capital growth. And I think Aspendale will outperform 8% growth. The thing about this is, it doesn't make a difference about what you're claiming. It's all about where the money's coming from and how much you're making. That's the thing. So when people talk about negative gearing, they either don't understand property investing at all, and more importantly, I think most of them don't actually have any property behind them, because to me, this is a kind of a non-event when we talk about negative gearing. If it's available, then you take advantage of it. If it's not available, then you don't take advantage of it, okay? It's still not going to impact how people invest. That's the thing that people don't understand. The government thinks that people are going to stop investing in property with negative gearing rolled back. It's just not true. Who pays in the first 12 months? The tenant pays 67%. Bill or you out of pocket 7%, taxman is 26%. So this is the thing that people have been telling me for years, and there's a number of dumb things that I've heard in property over the years. The dumbest thing I've heard by far is you always make money on the way in, which is just a stupid statement, because I was buying apartments for $97,500, years ago, and now they're worth $450,000. So how much would I have to make on the way in to beat a profit of $350,000? That means that the vendor would have to pay me $250,000 to buy the apartment. That's the dumbest thing I've ever heard. You always make money on the way in. No, you make money when you make money, and you lose money when you lose money. Would you agree? It's that simple. You don't always make money on the way in. Sometimes you do. Would you want to make money on the way in? Yes. A better statement is try to make money on the way in. I don't care if it's on the way in, out, sideways, as long as you're making money, okay? That's the thing. The dumbest thing, that's the most stupid thing that I've ever heard in property investing. But the other thing that I keep hearing about is, why would I buy a property that costs me money every week out of pocket, where I could buy a property that puts money in my pocket, okay? Now I wanted to go do a whole YouTube video just on this, cash flow positive versus cash flow negative properties. It's not the shortfall that's important per week, per month, per year in terms of the rental. It's the capital gain of the property. Property investing is all about capital gain. It's never been about rental. Now, if you look at the richest people, richest investors out there, they know that this whole game is about building equity or capital and then getting a line of credit and realizing that capital, or just selling the property and making money. The people that are chasing cash flow are always people who don't have assets behind them, because they think you can just get that $600 a week or $1,000 a week, I'll be out of work. That's not reality. Now, I want to show you an example here based on a $300,000 purchase, why growth properties outperform cash flow positive properties, both in terms of capital growth and rental yield. Now, let's compare a purchase of $300,000. If you go and buy a property, a growth property for $300,000, you can still get 1-bedroom studio apartments in Richmond, in good areas like Hawthorn, next to university campus, or even in St Kilda West. If they're well located, you're still going to get your 10% growth on those properties. Now they're becoming scarce and they're becoming more expensive. But let's say you do find something that gives you 10% growth and only a 4% rental yield, which is the reality of those properties, versus going regional and getting a 4% growth, but 10% cash flow positive scenario, right? So people would argue that if a property is giving me 10% return, it's superior to the property that's giving me a 4% rental yield. Well, yes, initially it's absolutely true. In year one, okay, your growth property has gone up by 30 grand, but the rental yield that you're getting is only 13,200, where here you're getting 31,200 in rent. So the relationship here is obviously this property is superior. The cash flow positive property is getting you more. But look what happens in year 10. In year 10, your 10% growth property, you've made, it's worth 778,000, okay? So you've made 478,000 in equity. Your rental is 31,125, because it's always 4% of the value of the property. Where you've got your cash flow positive property has only gone up $144,000, so you've lost money here. Look at the difference between the capital gain on these two properties. Okay, you're far behind here. You just lost 300,000, but also you're getting 44,470 in cash flow. Okay, so you are still in front. Okay, marginally, but if you look at the equity position, that's a huge difference. But if you're a buy and hold, never sell investor, look what happens in year 20. Your growth property is worth $2 million, giving you 80,000 rental per year. Your cash flow positive property is only worth $657,000 and giving you $65,000 per year in rental. So a growth property long term we outperform a cash flow positive property, both not only in capital gain, which is obvious, but also in the rental yield as well. So you can have the best of both worlds by accumulating these properties. And these property portfolios will always outperform these ones because here you've got more equity to buy more properties. Where here you don't have enough equity to buy more properties. You get more deposits being generated here than here. And that's why you can buy more properties doing this system than this system. Here you can buy more properties initially and you get more cash flow initially, but eventually you will stop because you're going to run out of deposit money. And that's what I've seen with clients all the time. When I used to run a mortgage broking company, I've met a lot of people that buy cash flow positive properties in regional areas. They buy 4, 5, 6, 7, and they stop. And it doesn't really change their life, you know. But I've also seen people buy 6, 7 growth properties and 10 years later, they're virtually retired. And that's the main difference. It's all about perspective. It's all about gearing. You know, this whole game is not about return on equity, return on asset. It's all about return on equity. It's how much you're putting in and how much you're getting out. This whole game is about controlling property using other people's money. It's got nothing to do with tax deductions or negative gearing or any of those other things. It's purely a game of accumulation. And here's the thing, an example. If you're not leveraging at all into the property portfolio, so you're putting 100 grand, you're controlling 100 grand worth of the asset. Let's say the growth in yield is 11% and the interest is 7%. Okay. Now I'll put 7%, normally interest rate around 4%, but you've got all the associated expenses and holding costs. It works out to around 6.57% if you work it all out. So your return is 11,000, your net return is 11,000, your cash return is 11,000. Let's put gearing into the equation. So you've got 100 grand, you're borrowing 50%, now you're controlling 200,000 of the asset, 11% on 200 is 22,000, less expenses, you've got a cash return of 15%. This is 80%. See what happens is the more you borrow, the more you leverage, your cash return increases. And that's what property investing is all about. Going 90, 95, borrowing as much as you can, leveraging other people's money to control property. Archimedes said, give me a place to stand and a lever long enough and I will move the world. This whole game, guys, is about property investing, is all about leverage, using other people's money. Interested in learning more? I want to give you a personal invitation to spend 2 days with me and other experts to learn how this whole thing works. And I'm really excited about this because I run these events from time to time, and these events fill out really quickly because we only cap the availability of these events to 40 seats. And in fact, now I've got people flying from all around Australia. In fact, every event that I've done this year, I've had people fly from as far as Dubai to attend these events. Now they are free, but they're very limited and exclusive. There's a number of speakers at these events, and I'm just going to give you a brief overview of what I'm going to do. And if you enjoy the content of this video, I strongly encourage you to reserve your tickets and attend one of these events in the future. First of all, we've got Stephen Molnar, who's the MC, and Stephen Molnar used to own a bank. One of the very few people in Australia that actually own the bank. He's also a very successful property investor. We've got Martine Angelique, who's a savvy accountant from Savvy Accounting Solutions. So she's a chartered accountant, and she'll be talking about buying properties in trust versus your individual names and negative gearing, of course. We've got Cameron Fisher from Changing Places Real Estate, who's a fully licensed real estate agent, and he's also a qualified valuer. He's also a director of buymyplace.com.au, which is a company that's listed on the Australian Stock Exchange. This guy's been in real estate for over 30 years, and he's done 5,000 successful auctions in Melbourne. Just have a think about that number, 5,000 auctions, 5,000 homes sold just at auction. Incredible wealth of knowledge. I'm there, of course, myself, talking about mainly finance and property investing and psychology. And then we've got Stephen McClutchy from Loans Australia, who now has settled close to $1 billion worth of investment lending for investors. So it's really an amazing event that we're running, usually in our head office in St Kilda or the Blackburn Hotel in St Kilda Road. It's a 2-day event, break it down to 2 days. Day 1 is purely about finance, due diligence and research and psychology. And day 2, which is really cool, we take you out of the classroom environment and we take you out and drive you around Melbourne. And we go through suburbs and we do extreme micro level due diligence on the ground. It's an incredible event. I'm very proud to hold these events, and the feedback from investors has been phenomenal in the last 5 years that I've been running these. But once again, they're very exclusive and they do book out really quickly. What I cover at the event is 4 critical things of building a property portfolio. Number 1 is psychology, which is very crucial. Number 2 is developing the right plan, the right system. Number 3 is developing a team of experts around you, which we cover as well, who you have to have working with you to achieve your results. And then understanding property selection methodology. Once you have these things synchronized, working together, that's the very definition of success. Also, if you've enjoyed this video as well, grab a copy of my book, Australian Property Finance Made Simple. You can jump on amazon.com.au and grab a copy, Kindle, Apple, or bookonfinance.com.au. And also, as a special bonus, because this has been a long video and you've stayed right to the end, and because you have, I know you're serious about investing, I'm going to give you a free home study with $497, no strings attached. And this is basically 10 hours of education plus a manual, and it's really super easy to use. It's literally point and click, plus you download the manual, and it's basically 10 hours of education. And all you got to do, if you can access this instantly right now, just go to the following link, or if you scroll down below, just below this video, there should be a link down below. Click and register, and you're in, and you're watching more videos. Thank you very much, guys. This is Conrad Bobilac, and I'll see you on the inside.